Do you know how loans really work? And then on top of that, let's go through a little bit of why I like money markets over high yield saving accounts right now. What's up, everybody? Chris Lee, Everyday Finance 101, coming at you with a longer form video today. I'm going to go through a Google Sheet with just really explaining loans and amortization tables because I think it goes into the decision factor of if you're switching houses and as well as some other kind of debt that you're taking on. And then my take on why I like money market accounts over high yield saving accounts and showing you two of those options in general with some ramifications to it. So let's get started. We are going to start with the Google Sheet. And I just want to show you how loans work because I don't think enough people are taught this in school. And so that's what we're doing here on Everyday Finance. So the first thing I got here is pretty simple. I got a loan amount of $15,000 and it's for 5 years at 7% interest. Now, with any debt that you're ever going to take out, I am under the philosophy that you should know how much you are paying on that debt before you take it out. And there is a lot of cool tools on the internet that allow you to do that. And so if you just do a quick Google of a loan calculator, something like this will come up. And so I'm using this one for a later purpose that you'll see. But we had $15,000 loan for 5 years at 7% interest. And if I hit calculate right here, it is going to pop open that payment that we just had on the other sheet. So right here you can see $297.02 is exactly where I got that monthly payment, and that loan will be paid off in 5 years using 7% interest. Okay. Now, something to note with that loan overall, you will end up paying close to $3,000 in interest. Obviously, when you take out other people's money, there's interest on it. And so the thing that I wanted to show you was that over here, although the loan was for $15,000, you ended up paying another $3,000 because of the interest. So the total cost that you paid was near $18,000 for taking out the $15,000 5 years prior. Okay, I don't think that's a shock to anyone. Now, here is what I don't think people understand. How loans work, at least that have a finite timeline on them, is that you pay down the principal, but you have a bigger principal balance at the beginning. And so when you look at an amortization table like the one here, it shows you exactly how, I don't know why my line went way up there. It shows you exactly how much interest, I guess we're just going to be difficult today. It shows you exactly how much interest is going to be on every single year. You can even do it and switch this to a monthly schedule because then you can see every single month how much interest versus principal your payments are knocking down. So I'm going to keep it on the annual schedule, but I wanted to show you that on the first year, you are only paying $2,500 in principal and almost $1,000 in interest. And you can see that it flips by year 5. It goes all the way to $3,400 in principal and only $130 in interest. So I wanted to show you that back on the Google Sheet as well, because how loans work is as the principal balance gets knocked down, the interest overall gets less. So your first payment that you make year 1, month 1 will be the highest interest payment, and every future payment after that will have interest going down and down. So I wanted to show you here with a simple example that year 1 versus year 5 difference. And towards the end of a loan, you will always be paying more in principal. Now, with a simple 5-year loan, it might not be a big deal, but when we go to a 30-year loan, there is a big difference, like a mortgage. And I wanted to show you this because a lot of people bounce around houses, and when you continue to reset your mortgage, you are killing yourself with paying interest up front. So let's go to this page over this tab over here. And so I have a new loan in here. So if I type in $300,000, this is the loan, not the house cost, whatever loan you took out. Current mortgage rates are about, I'll go 30 years. And then current mortgage rates for a 30-year, about 6.5%. So if I hit calculate there, you're going to see the monthly payment of $1,896.20. So I have that written over here. You're going to end up paying $300,000 in the loan. So you're obviously paying back the amount you borrowed. And then this is the crazy part, over 30 years at this interest rate, you're going to end up paying over the loan amount, actually 380,000 additional in interest. So that's where banks make money. And so the total cost of the loan, even though you only took out 300,000, ends up actually being $682,000 over the course of 30 years. I'm not saying mortgages are bad. I'm just saying understand what you're paying for over a long period of time. Now, here is the kicker I really want you to understand that we went over on that last one, is that in year one, you are ending up paying, let me get back to my pen. Year one, you only pay $3,000 in principal. You pay $19,000 in interest. Again, because your loan balance, this $300,000 up top, is at the highest point it will be at the beginning, you are paying fractional interest on that. And so that is why early on in an amortization table, you have such heavy interest up front. So 19,000 year one. It doesn't flip you paying more in principal than in interest until year 20. Isn't that kind of crazy? 2/3 of the way through this thing, that is when you finally pay more principal than interest. And finally, in year 30, you would end up paying $22,000 in principal and only $780 in interest. So if you continue to buy and sell a house every 3, 5, whatever years, you are resetting the interest front. And even though your monthly payments are partially going to principal, you are paying a crap ton of interest. So this monthly payment that we have here, this $1,900, at the beginning of a loan, you're paying, I don't know, maybe $1,500 plus. Let's see here. Let's do the math on it. So we have year one was $19,400. So if we just divide that by 12, $1,600 of that $1,900 every single month on average is going towards interest. So when you reset loans constantly, you're killing yourself, because although you're making a monthly payment, most of it's going towards interest. So if you feel like you're not getting ahead and you're not knocking down principal balance, it's probably because you're resetting loans too often. And so that goes back to just like my overall philosophy. You want to be in a house for a long period of time. That's like a true wealth builder if you're going to stay and knock down principal. But the other side of it is if you constantly are moving, you're going to keep resetting the time period on it. And that's just really a killer overall, because then you're just giving more interest to the bank up front. So I don't think enough people understand that. Take the loan that you have, go pop it in an amortization calculator and see what's going on, because I think that's just really valuable tool to understand on a forward basis. Okay. The other thing I wanted to go over was the difference between a high yield savings account and a money market account, and the difference in interest rates that you can get and what difference that might make in your bank account. So two that I love, and I've gone over these a little bit before, but Ally has a great high yield savings account. If you don't have a high yield savings account, I don't know what you're doing. If you're keeping your money in a traditional bank or even CDs, like high yield savings accounts are paying close to the same amount of CDs. And these are all FDIC insured, NCUA if it's a credit union, or if you're on a money market, then it's SIPC insured. So I don't know why you would be keeping your money in a traditional bank getting 0.01% interest. That to me is just silly in 2025. And so Ally, they pay 3.5% no matter how high your dollar amount goes. And so I kind of did a little cross comparison here, but I want to show you Fidelity first, and then we'll kind of cross over. So that's a high yield savings account. That's what Ally is. Ally is an online bank. Because they're online, they can pay you more interest because they don't have all the brick and mortar stores and things like that as far as overhead goes. And so now if I go over to Fidelity, Fidelity is a brokerage firm, but you could buy a money market through any brokerage firm. And so when my money is sitting in Fidelity, it's sitting in a government money market fund called SPAXX. And SPAXX actually right now, I'll zoom in so you can see a little bit more. SPAXX is earning every single year. This is just like a 7-day yield, but you get paid out every month, but it's for the whole year. 3.97%. That's after the expense ratio as well. So 3.97% versus Ally's 3.5%. Let me show you the difference on that. Well, if we have, so 35397, if we have 10K in Ally over 5 years, I'm going to use a compound interest calculator here. And again, I'll link all these things. But $10,000, 5 years, Ally pays 3.5%. Ally pays out their interest every month, so we can compound it monthly. You would get 11,909.43 as far as Ally is concerned. And so your money over 5 years grew $2,000, which is awesome because a normal bank is going to grow maybe a couple cents based on their interest. Fidelity, on the other hand, I know you can see the answer there, but I want to show you the compound interest. If we change this interest rate to 3.97 and hit calculate, again, both are risk-free and besides a USA financial collapse, you would get $12,191.73. And so I know it's not a huge difference, but it is a difference of $282. And I'm a big proponent of getting little wins in your bank account if you can with simple clicks of the button. And so I wanted to show you the difference there between a money market account and a high yield savings account. Both act and do the same thing. They are just sitting there in cash, very safe for you, whether it be SIPC insured or FDIC or NCUA if you're with a credit union. But little wins stack up over time, and I want to show you that with your money because a lot of people have more than 10K sitting on the sidelines sometimes, depending on how you manage your life and your finances, and they can make a big difference on where you plug it in as far as where you're holding that cash side of things. So I hope that's helpful today overall, kind of going through multiple things here. First, going through a loan and amortization schedules and how that works, and then second, going through money markets and high yield savings accounts. I kind of just like this was picking and plugging and playing some multiple things in here. If there's anything you guys ever want to see, let me know. But other than that, Chris Lee, Everyday Finance, and I will see you guys in the next one.